Good afternoon, everyone. This is Michael Browne, Head of Commodities at Barchart, and I am joined today by Alan Brugler, President and Founder of Brugler Marketing and Management. Today, we're going to take a look at the grain market outlook and talk a little bit about the USDA report that came out yesterday and the market reaction to that. Alan's got a number of slides here to go through, and we'll bring you up to speed on some of that. And then later in the session, I'm just going to spend a few minutes going through some of the new tools and features in Commodity View and our Marketplace app. And then we'll have time at the end for questions and answers. So if you do have questions, there is a question panel within the little control panel for the GoToWebinar. Just enter your question there. I'll monitor that panel while we're talking. And at the end, we'll address any questions from the audience. Very good. I'm going to just introduce you then to Alan Brugler. And Alan, take it away.
Well, thanks, Michael. I appreciate this opportunity to visit with everybody. It's been a rather exciting market this week, as most of you know. Just a few words about Brugler Marketing Management. Some of you may be more familiar with us than others. We're an advisory and analysis firm. We're based in Omaha, Nebraska. I've personally been in this business for more than 40 years. My CFTC registration number is 279, which tells you I was back at the very beginning. The main services that we offer are Ag Marketing Professional, which is daily analysis and recommended hedging advice for futures, options, basis, LDP, and so forth for the ag commodities. We've got some popular tools called special research reports, which look at both fundamental and technical factors, and some proprietary tools like our price and probability forecast and the techno-fundamental forecast, which you'll see in a little bit here. We also do marketing training, advanced technical analysis workshops, and options workshops, and serve as a consultant on projects for both individual farmers and for agribusinesses. So it's a great pleasure to be with you this afternoon and give you a little bit of our perspective on particularly the corn and soybean markets. Let's roll to the next slide. There were two major USDA reports yesterday, the Planting Intentions Report and the Grain Stocks Report. The intentions is what got all of the traction and all of the market movement. I know this is a very busy slide, but it's important to look at a number of different things on this slide. As you go, vertical columns are 16, 17, 18, those are the years. So 21 would be the data that was released yesterday. Our Brugler estimates are to the right of that, what we thought they were going to be. But if you would focus on that 21 column, corn acreage intentions, 91.14 million, soybeans, 87.6 million, and a little further down, winter wheat, 33.078. We could go into more and more detail, but the main thing is that the wheat number was about a million acres larger than the trade had expected, particularly the winter wheat. That's normally a final number in January or pretty close to it. So USDA surprised us by finding more wheat. That made wheat the weakest sister of this equation. And while it rallied yesterday, it gave back those gains today. Corn and soybean acreage were much smaller than the trade guess. Trade guesses were pretty close to the Brugler estimates that you see on the right. And we got a really stout reaction out of this. It took less than 2 minutes for the soybean and corn markets to go limit up yesterday. I want to point out a couple things on this table, though. This is what we call a principal acres table. It tries to count for all of the main crops that are grown in the United States, including hay, which is over 51 million acres. If you look down, be 3 lines from the bottom, you'll see the primary crops total, 316.164 million acres. This is light, okay? It suggests that USDA's survey did not pick up all of the intended acres for this year. We have to ignore the last 2 years, which had fairly substantial prevented planting due to flooding. producers filed for insurance rather than planting. But if you go back to the 16, 17, and 18 columns, which is the reason I have them on here, you'll see that in more normal conditions, we plant 319 to 323 million acres of primary crops. USDA's intentions report only captured 316 million for this year. So to my way of thinking, there's 4 to 5 million acres missing here, all right, that can show up at a later date. It seems particularly unlikely that we would be that low on acreage, given that we are at 5 to 7 year highs in prices. Producers have more incentive to plant this year than in any of the other years since 2013, 2014. So this suggests we're a little light. Kind of a cross check on that. If you go down to the bottom line, we added the CRP acres, the government set aside acres, and then conservation acres, and then we added the prevented planting for all the other previous years. So that can vary quite a bit. It was only 200-some thousand acres in 2012 drought year, and when it's dry, the lesson is everything gets planted. Doesn't always yield, but it gets planted. And the max was a little over 20 million pp in 2019. You can see the difference between 304 million for primary crops and 346 for the combined. But again, if you look at the 343 million for 21, and then look across the columns, you see 343, 346, 344. I'm going to the left here, 345 and 351. So my 343 includes 7 million prevent plant, which we think is double what it's likely to be. And it's still light compared to these other recent years. So the main story here on this slide is that the numbers were low, but they're likely to get higher going forward. If we could go to the next slide. This is USDA's self-reporting on the accuracy, reliability of this report versus final acreage, which of course is what drives yield. You'll see in the root mean square error column, USDA tells us that the March intentions are usually 2.1% away from whatever the final is. On the soybean side, 3.2% from off of final. Cotton is typically 7% away from the final acreage, so there's a lot more variability there. And durum wheat is 21% variance. So this tells you that the corn number is typically within a couple percent of final, but we have to remember if we're talking 91 million acres, that even 2% would be 1.8 something million. Okay, so even within their normal performance, we could pick up an extra 2 million. If you look at the leftmost of the blue circled or squared off columns, you'll see that the average switch from March to final is 1.288 million acres for corn and 1.633 million acres for beans. So it's possible those could go down instead of up. That's what prevented planting is all about. But these would be typical increases in acres for those two crops based on what the normal reporting sequence. It is possible to be much bigger. The right-hand column shows you that the largest variance from March to final was 6.171 million for corn. That was actually last year, and 8.517 million for beans. So these averages are kind of our base case here for an increase in the June report based on this rally today, and yesterday, which is trying to buy acres, and just a history of typically finding a few more acres than what we started out with. Next slide, please. This focuses specifically on the corn in the March to June changes. Of course, last year with the wet conditions, 2019 we had the flooding, but we knew it early, and the acreage estimates were low from the get-go. In 2020, it was more rain and extended rain, and we ended up not planting some ground that we thought we were going to plant in March. So USDA found almost 97 million acres in the March intentions and was not anywhere near that got in the ground. But the point is, big negatives the last 2 years, but before that we had a string of years where the June intentions were larger than the March. Next slide. And finally, this is a table from what we call Corn Yield 3. It's one of our 1,800 spreadsheets that we maintain. This shows you the last 71 years worth of data for corn acreage. In this first line, the average change from March to June is actually a reduction of 441,000 acres. The average from March to final is a reduction of 841,000. That's because weather causes changes in planting intentions. In the last 10 years, those switches have been a little different. You can see the numbers there. Again, we think at this point, as long as it stays on the dry side, we think the bias will be towards more acres. The maximum increase in corn acreage over the last 10 years from March to June has been a little over 1.1 million. The largest change from March to final in the last 10 years has been 1.291. So to be conservative, we would expect that the June acreage might pick up an extra 1 million to 1.2 million. You can see there's a slight statistical bias, 6 years up to 4 years down over the last 10. Next slide. We did have another report yesterday, which was grain stocks, and we track that separately by region. This is the Western Corn Belt region, which we define as Iowa, Nebraska, Minnesota, Missouri, and Kansas. And you can see that corn stocks are tighter. And in fact, the estimate yesterday was about 60 million lower than the previous trade estimates for yesterday's numbers. So it was a little tighter than expected, but this says we're down 3.4% in that region. This has basis implications. Basis, of course, is the spread between the cash market and the futures. And Commodity and Barchart do an excellent job of capturing the cash market data. The basis has been stronger all year than the last couple of years, and this is a good justification for that. There's just less corn in that 5-state area that's available to the market as of March 1, which is halfway through the marketing year. If we go to the Eastern Corn Belt slide, which is next, you'll see that corn stocks there are also at a 4-year low. This is broken down as individual states rather than a stacked bar, but Illinois is typically the big reservoir of corn there on March 1. And you can see very similar stocks to a year ago. They have not really recovered from the bad weather of the last 2 years. They're typically would have bigger stocks than we are seeing here. Indiana and Ohio much closer to their recent norms, but again down from 17, 18, 19. So basis is firmer in the Eastern Corn Belt. It's not as dramatic as it is in the West because it's always fairly strong in the Eastern Corn Belt. There's a lot of multiple places for that corn to go. Next slide. So if we put these together into a balance sheet, we know what USDA said in the March WASDE report. That's the left-hand white column. But we know that it's going to be different on April 9th, a week from Friday. And the best fit column is where we think they're going to go on that report. We did raise our feed and residual use by about 20 million bushels from what USDA used in March. That reflects part of that 60 million change that you're going to get on the that you got in the grain stocks estimate. I should point out almost half of that grain stocks surprise was actually a revision to the December quarter, and will have to flow forward. You'll also notice that we are using 100 million bushels more exports than what USDA reported in March. That reflects the big Chinese purchases that were made in March after the USDA compiled their data. They actually bought more than 100 million bushels, but we think there'll be some crowd out effect in terms of shipments. So our anticipation right now is that the ending stocks would be lowered to 1380. USDA might only go to 1.4 billion for this report, but it is still getting tighter. The grain stocks would suggest that. The export activity would suggest that, as long as it gets shipped. And the stocks usage ratio would tighten up to 9.4%. That would allow the cash price at the farm level to rise 450 to 460 for the year. Now you may well ask, well, why so low when corn futures are trading over 550 now? The reason is a lot of that cash corn has already left the farm. In fact, the on-farm stocks were down about 9% from a year ago. So it's out of farmer hands and has already presumably been priced in some fashion. So you've got a fairly high price now, but you have fairly small quantities of corn still to be sold at that higher price. So the weighted average doesn't change that much. One of our proprietary tools in this techno-fundamental forecasting is we take that cash price, we look at all the data since 1980 for futures trading over that marketing year. And the average, long-term average trading range in a marketing year is $1.37 for corn. Then we figured out where that cash average price falls within that range. This suggests that if 460 were the cash price average for the year, the futures range in an average year would be 418 to 555. We've actually traded up as high as 585 last night when this slide was put together. And but as we go home tonight, we're at 559 3/4, 560. So we're a little above an average range. We've had a much larger than average range, $2.41 for the year to date. If there's more juice here, if the market needs to ration cash corn further to keep this from going down to $1.1 billion or $1.2 billion, we need to go back and look at some of the big range years. And we took the three largest trading range years going back to 1980 and averaged them, and that's $3.89 a bushel. This suggests there's at least some potential for prices to go as high as $7. That would probably have to be a combination of some distress in the Brazilian second crop corn that makes them underperform current production estimates and results in fewer exports this summer and fall from Brazil, and combined with some kind of a crop problem here in the U.S. that threatens the new crop availability. So I'm not sitting here today and saying we're going to see $7 corn. The easy money was to 555, and that's been done. Moving over to the new crop, the low production estimate, which is the second column in from the right, is using USDA's 91.14 million acres from the intentions report. And for this one, we dialed in a 178 yield, which is a bushel and a half below what USDA used in February at the forum. That would give you a 14.8 billion bushel crop. And that's only about 600 million bigger than this year. We do see consumption larger, over 15 billion bushels total disappearance versus 14.6 in the current year, or maybe 14.75 when USDA makes further revisions. Bottom line is this does tighten up stocks quite a bit. If the acreage is that low and the yield is 178 or less, you're talking 1.0 to 1.1 billion bushels, potentially even lower than that. Stocks usage ratio gets down below 8%. Cash price starts to work higher. Our model uses 480 at this particular point. The timing of those highs and lows makes a big difference on that weighting. But at 480, you'd conservatively expect nearby corn, which would be the D's right now. This actually doesn't go into effect till September 1, to be 575 on the high, 438 on the low. We were trading 488 yesterday, and of course 484.5 on the settlement today. So this suggests where, if this is the scenario that actually develops, if those low acres stay low, we've got a lot more work to do on the upside on December corn prices. Our conventional model suggests we'd have 93 million, or 93.5 million acres, that we would pick up 2.4 million between now and final. And because this is being used as our bear scenario, I raised the yield to 182. Dropping down to the carryout, that gets us back to 2 billion bushels, which is where we've been mired from 2014 through 2019. And that takes your cash price back to $4 or less. And if that's the case, then these futures prices for December are 95% of the expected range. You should be selling here. That's all for that slide. Just a quick glance at the chart action. We have been in an extended rising regression channel since last fall, since last August. That's pretty well illustrated here. There's been good buying on the dips to the lower channel boundary. We look like we spiked it, and we're finally breaking down to the downside earlier this week. And then, of course, the report came out, and now we're back into the channel. This suggests there should be pretty good support in the high 540s, and some resistance, obviously at 572, which is our 50% retracement of the drop from 2012. We are cautious here on the old crop side of things because some of the technical indicators are still bearish, but we do like this action over the last 3 weeks of popping up in the channel. Next, please. Let's talk about soybeans a little bit. Following slide. The soybeans have been trying to buy acres for quite some time. This is the new crop soy corn ratio. We're taking November soybeans divided by December corn. The black line is this year's line, and you can see that it's been hovering around 2.6 to 1 for most of the 2021 calendar year. Current ratio last night was 2.55 to 1, but anything historically over 2.3, which would be about where the green line, the top part of the green line is, would buy you more soybean acres. 2.5 buys you a lot more bean acres relative to corn. So the soybean market's been trying to get more acreage away from corn, or at least get more acreage into beans from other crops for quite some time. So we were expecting, and most of the trade was expecting, a big rise in soybean acres in this report, and we did get some. If you remember our first slide, while it was below expectations, it was above last year by about 4 million acres. There's a couple lessons on this slide. Number one, the bean market's still trying to get acres. Number two, if you look past that first blue window, the left-hand side one that's labeled prospective planning, you'll notice that that ratio typically collapses after the report comes out. All right, the market has made its effort to get the beans bought, and often does not compete quite as hard against the corn after that. You'll see that in 2019, when we had the major flooding issues, and corn acreage was going to be well below the expected, and prevented plan ended up being 20 million. The market was trying, even in late June, to attract more corn acres by taking that ratio clear down to 2 to 1. That was late in the cycle. It was basically encouraging farmers to take a risk and plant corn, even though it was past the ideal planting dates. Conversely, if you look back at 2016, the market was still trying to buy soybeans just past that June acreage report window. The green line in early July, over 3 to 1, basically saying, let's plant some more double crop beans into wheat stubble. We need the beans, period. So I'd encourage you to keep an eye on these soy corn ratios. Most producers don't use them explicitly. That is, nobody sits there and says, well, the soy corn ratio is 2.6, I should plant more beans. But it does represent pretty well the relative economics of corn and beans for the producer. Next slide. Going back to our crop report, this shows you soybean acreage shifts from March to June. We showed you the corn one earlier. You can see typically the maximum shift is about 4%. We saw a 4% drop in 2007. We saw it again in 2019 with the flooding. On the other side of things, you can see a 4% jump in 2014. You had a more than 4% jump back there in 1991. But most of the time, that swing is less than 4%. And in fact, in most cases, it's only about 2%. Well, 2% on not 87 or 88 million acres would be 1.7 or 1.8 million either way. Again, our bias is that the overall acreage count was low, and it would be to the upside, that we would pick up another 1.6 to 1.8 million on the beans. Next slide. What have the bean futures been doing? Well, we've had that same rising regression channel since last August that we saw on the corn. The rising tide has been lifting all the boats. You'll notice that on the left here, we've got some retracements. That 1407 is the 61.8% retracement, a Fibonacci retracement of the decline from the 2012 all-time high, $17 and change. This has been a problem for the market. We've had 4 weekly closes out of 11 weeks. Make that 12 weeks now that we're above that resistance. Okay, so most of these weeks the close has been above that technical resistance, and today was a good example. We were above it nicely yesterday, but sold off today and ended up closing at 1402. So that's still, we can still consider that to be significant resistance, even though we have traded briefly as high as 1460. As with the corn, some of the technical indicators like the stochastics are bearish, but the chart action doesn't necessarily go down here. The channels are still intact. Next slide. We did have a stocks report for soybeans as well. The second quarter stocks, which is the March 1 stocks for soybeans, are the lowest in 5 years. All right. A little over 1.5 billion bushels, 1.564, I believe. So that's tight, and that's why you're seeing strong basis bids on soybeans around the U.S. right now. That's corroborated by USDA's forecast for the year-end stocks, which has been coming down all year. Started out at 200-some million. Now we're talking 120. Trade at speculation that's going to 110 or 105 or something. The point is things are much tighter, and the prices are somewhat reflective of these tighter stocks. Couple that with a huge rally in soybean oil. I don't have a slide on that, but soybean oil has rallied to the highest prices since 2012, 2013 time period. On a variety of things. Part of that's expected biodiesel demand for soybean oil to make into fuel. Part of that is tighter stocks of both palm oil and canola oil, which are two main competitors for soybean oil. And part of that is tied to the expected expansion in consumption here as the U.S. economy recovers and rebuilds and reopens after COVID. Next slide. How do we get to that big drawdown, that 700 million bushel drawdown in stocks? Basically, this tells it all. The red line is the exports for the second quarter. That is December, January, February quarter. China bought a big chunk of that and shipped it. Okay, we've shipped a lot of what we sold. So you did have record large soybean export offtake, if you will, for the second quarter. The blue lines are a little harder to read. That's the crush line, but that's also a record for the second quarter. We had records in December and January. February numbers will come out, or just did come out this afternoon, but the quarterly number is still a record. The green bars are seed and residual use, and they're negative for the quarter, meaning USDA found some beans that shouldn't be there based on the other usage categories. So negative residual is, we found it and we don't know where it came from. You can see that that's fairly common here in the second quarter. For the last 5 years, we've had a negative residual in this quarter. But the trade average guess was not anticipating that. Let's move to the next slide. And this is the one that takes a little bit of time. Again, the March WASDE report is in white on the left-hand side. And the A best column is where we think they're at today based on this grain stocks report. We actually are still with that same crush number, 2.2 billion bushels. We think the exports could be bumped up another 10 or 15 million. The problem there is not export sales, it's the fact that we're going to be down the pipeline supply by August. We think the fourth quarter exports are going to be extremely tight, or very small, because of very tight supplies. So our ending stocks estimate, 116 million bushels. We do think that to keep that export that small, we have to have some price rationing to prevent the crush industry from using any more beans, and basically slow down the foreign buyers as well. So the cash price does work higher towards 11.45 for the marketing year. Using the same type of analysis that we talked about before, we're looking at the 12-month marketing year price ranges for soybeans. If you look at the 6 years where stocks usage ratio was tighter than 5%, and we're talking 2.5 here, the average trading range is $4.14 in those 6 years, going back to 1980. That would imply with 11.45 cash, high futures would be around 14.19. We have gotten higher than that. We've got up to 14.54 because we've already had a $5 range. So this is an unusually volatile year in terms of price movement from where we were last fall. We did run a different type of model. It's labeled polycurve, but what that means is we were using a polynomial equation to plot the trading ranges against the the stocks usage ratios, trying to make it more adaptive to the tightness. That is, the tighter the stocks, the larger the trading range tends to be. And what you see here is that does give us about $1 higher, $1 wider range than an average tight stocks year, and would suggest that old crop beans could get up into the 1480s in a typical year with this tightness of stocks. Obviously, if it goes to 100 million, then that range will expand some more, and the cash price with it. Bumping over to new crop, similar methodology to what I shared with you on the corn side. The 87.6 million acres in the A-low is the planted intentions report. That's what USDA gave us yesterday. We dropped their February yield of 50.8 down to 49 because we're trying to show the tightness here. And you could argue that that's in a dry year, dry start to the year, that it might impair the yields a little bit. We'll see how that plays out over time. But the point is, we're trying to show you what happens, why the market was so excited yesterday, why November beans rallied 70 cents, and it's quite clear. If you have a smaller yield and only 87 million planted, you're talking 4.25 billion bushel production, which is less than 100 million above a year ago, and quite a bit less than USDA estimated in February. You end up having, you can actually get a negative carryover if you use USDA's white column there for consumption, for the 2.2 billion and the 2.21 billion for crush. So what you have to do is you have to have some fairly severe price rationing to make the crush slow down, to make the exports slow down by at least 150 million bushels, because the market is solving for the equation of pipeline supply. We think the absolute lowest pipeline supply we can have with a 4.2 billion bushel annual use is about 95 million bushels. 110 and 120 is more likely. But again, to get it to 95 and not less, we have to have cash price average up in the 14s. And this sounds awful high compared to USDA's 11.25. But if you go back and look at some of those years in 2011, 2012, 2013 that had similar tight stocks, we did see some $14 cash in that era. Using our polynomial curve, if they are in fact 1440 cash for the year, we could see a range of 13 to 16. We're only, November futures are only trading 1256 yesterday, 1263 tonight. So that's actually outside, that's below the range that you would expect to see prices if this is the scenario that actually develops. So that's why the soybeans rallied limit up yesterday. Hey, we're way too cheap if this is all over the ground we're going to plant and there's anything wrong with the crop yields. All right, now, again, going back to my first slide, I think we're going to get a little bit more acreage in final. It may be coming out of the implied prevent plant. It may be double crop soybeans. I think that's one thing that's been overlooked by the trade here, and that is that in those acreage totals, if you plant more double crop beans, you increase the U.S. Principal crop acres. All right, they get counted twice. They get counted as wheat, and then they get counted as beans. So the market's job, one of the market's jobs here, is to provide incentive for producers to plant more double crop beans after they take off that winter wheat. And we're assuming that under the high production scenario, we get another 2.4 million acres, and 52 bushels an acre yield is not all that aggressive of an estimate. That's basically where we were in August before the derecho hit and the drought hit Iowa. So we're not asking for all-time record high, way out of the park kind of yields. That would be more like 56 or 57. But at that scenario, we do get the ending stocks back up to 279 million, 6% stocks usage ratio. The market would consider that to be much more comfortable. We used an $11 cash price here. One could argue it needed to be a little lower than that, but we think there will be a lot of forward contracting done with NOV beans in the 12s here that will raise the SEPOC NOV cash prices. Those contracts are delivered. So at $11 beans, 1285 would be about your max. And so November, if the market suspects that the right-hand column is actually going to develop, no beans will probably run a little more resistance up in the 1280s, and as they get closer to $13. Next slide, please. Just one last slide here, and then we'll turn it over to Michael and turn it over to some Q&A. We did have wheat stocks and wheat acreage. You saw the wheat acreage number at the beginning. Winter wheat was a little over 1 million higher than expected. Spring wheat was about as expected, 11.7 for other spring, which includes winter or spring white, by the way. But the wheat stocks report from the grain stocks also showed that we're fairly tight on wheat. Wheat production has been declining for years and years here in the United States. It's just not financially as attractive as corn and soybeans. And stocks have started to reflect that. We're drawing down the year-end stocks year over year, and that's reflected here in our third quarter, with wheat's on a June marketing year, remember. Third quarter of 1.314 billion bushels. Now that was a bigger number than the trade had expected. So it was a little bearish, and we saw that reflected in today's price action. Wheat was getting a lift from corn. When corn kind of stalled out, wheat said, I'm out of here. But we are tightening the stocks, and the market would get a lot more excited if they were 1.1 billion. Then we'd be talking 750 kind of futures. But this is still constructive for long-term price action in wheat. And I believe that's our last slide. If we can hit it one more, just a recap again. I'm Alan Brugler, Brugler Marketing. Going to turn it over to Michael. He's going to share a few things with you, and then we'll come back for questions and answers. So if you've got questions and answers about some of the things I shared with you, please forward them to Michael. My contact information is here on the bottom. Alan B. at bruglermktg.com. There's our office number, 402-697-3623. And there's our website, and we'd be happy to visit with you at any time. Thank you for this opportunity and for taking time out of your day to visit.
Okay, thanks a lot, Alan. I appreciate it. Great review, and we do indeed have some questions that came in while you were talking. So I'm just going to give a kind of a quick overview and update on some of the things that we're working on at Barchart, and then we'll go back to the questions and wrap up with those. So just kind of an overview here. As many of you know, Barchart provides total enterprise solutions for agribusiness. Those consist of our commodity view, which is our merchandiser desktop, which has access to global futures and options data, global cash prices, both interior prices in the US and Canada, as well as FOB and SIF prices at all major ports globally across a wide range of commodities. It also has access to our own proprietary data, fundamental data. A lot of the data that Alan was using in his review there is all available in Commodity View, both the current updates as the reports come out and the historical data for history analysis as well. Then we have our marketplace apps, which is our branded, fully branded producer apps for the farmers, where the farmers can get access to the grain elevators cash bids, futures data, weather, and news. And then they can also submit offers, get access to the contracts and tickets, and chat with the merchandiser right through the marketplace application. And then finally, our content management solutions. About 400 agribusiness clients today use either our hosted websites or our content to power their websites. We also have data feeds to power your own proprietary applications, web portals, and so on. So it's really like I say, a full enterprise suite of solutions for agribusiness. And the other part of these enterprise solutions is that we really integrate the whole workflow of the grain merchandiser to the producer. So again, the Commodity View Pro is kind of the centerpiece of that, with access to all necessary information, data, and content that the merchandiser would need to manage the markets, manage the incoming offers from the producers, check fundamental and cash prices, and so on. And then the marketplace app, which we talked about, you can see some screenshots here where the producer can really, at his fingertips, see exactly what's going on with his accounts with the elevator, and get access to the merchandiser, get access to cash prices and futures and options information. One big area that we have focused on very heavily here over the last 6 months or so is integrating these solutions into your back office, so your grain accounting or your ERP systems. Currently, we have partnerships in place and integration completed with AgVantage, AgVance, Oakland, Cultura, Vertical, and AgTrax. So these are all fully functional, deployed, integrated solutions. And we have others on the horizon that we're working on right now. Merchant Ag from UFC Systems, MTech Systems, iRely, and Christensen, are now called Beyond. So by the end of Q2, we'll have 10 or nearly a dozen ERP systems that we are fully integrated with, which is really an industry leading accomplishment there. So what does this do? This provides, all of that information that the producer is looking for beyond, just the typical cash prices, futures, weather, those sorts of things. It also gives them complete access to their contracts, their tickets, their balances, and their settlements. And then on the very near-term horizon is e-sign as well. So essentially, a producer will be able to create an offer, send that offer to the merchandiser. The merchandiser can accept and manage that offer right within Commodity View. When the market moves and that offer comes in the money, the merchandiser can accept that offer as a contract. That contract gets pushed down to the ERP system. Both sides are alerted to that activity. The producer then has access to, the balances against any contracts that are open, and so on and so on. Contract is sent out electronically, signed through e-sign, and returned. So very, very much a full closed loop integrated workflow system that we've created here. And so be happy to talk with any of you about those complete solutions. So with that, I'm going to kind of address some of the questions here that have come in, Alan, if you're ready for those.
I am ready.
All right. One that we had was, I think, a really good one is, what is all this likely to mean for basis and spreads going forward through the season here?
Well, I think the tightness of the stocks relative to the last few years, and you saw that in corn, soybeans, and wheat, is going to keep the basis firmer than usual, firmer than a 5-year average, say, for most locations. The strong export program kept the basis for beans pretty stout, but now that's starting to wind down, so we're losing that push there. It's mostly the domestic crush demand on the bean side, but the weighed against the fact that we now have a multi-year low in stocks. So it's mainly the crusher for the fourth quarter. Brazil's going to dominate the export program in that June, July, August quarter, but we're going to see, I think, potentially some really phenomenal basis bids, because we're going to get to the bottom of the barrel on the beans. I've told people that it would probably be in a declining futures environment, but we could potentially see a $2 over basis at some point this summer if some crusher or exporter is short a load and needs those badly before new crop is available. Don't hold me to that, but I think that there is a scenario where that could happen, at least for a week or two, waiting on new crop to develop. Corn basis is again going to be well supported here for the next couple of months, because the stocks numbers are tightening. USDA revised the December stocks down. The March stocks were a little tighter. We're not going to run out based on current information. We're still talking a 1.3 billion bushel carryout, but those bushels need to get on a boat. Many of we've got a likely record export sales program in the March, April, May period, on export shipment program, I should say. We're estimating between 800 and 900 million bushels loaded out during that quarter. That's a tremendous sucking sound that says a lot of that grain's got to come to the river, come to the railhead, and get on a boat.
Okay, excellent. How accurate do you see the soybean production area forecast, I guess acres, for the next season in the U.S.?
Could you repeat that? How accurate?
Yes, how accurate do you see the current production area forecast for soybeans?
Well, USDA's addressed this in their Lance Honick, the head of NASS, who we're well acquainted with, has a StatCast chat that he does after these reports. He was asked about the survey accuracy, and basically said the reason the bean number is so low is that's all that they could get the surveyed farmers, and there were over 78,000 of them, to say they were going to plant. So they're saying, in a way, they were saying if there's a problem, it's because the farmer gave us bad data. I think that's a little bit of a cop out, but on the other hand, I think that again, there's probably some uncertainty about the acreage. You're not deliberately misleading USDA, but you might be conservative about reporting any double crop intentions for beans because you don't know when your wheat's going to be mature and off the field, so whether you can get the soybeans planted. You don't know what the summer weather is going to be, if there's going to be enough moisture there. So there's going to be a tendency to under-report that. I think another wild card here is simply that we've had a tremendous increase in fertilizer prices over the last 90 days. That hits corn a lot harder than beans. And it may make some producers that are a little more highly leveraged, a little tighter on cash, tip those marginal acres that they haven't already put pre-plant treatments on or already put fertilizer on, might make them steer more of those towards soybeans just because they don't want to lay out the cash for the very expensive fertilizer at this point. So again, my bias is the soybean acreage number is a little light here. All of these acreage numbers are assuming that the weather is good this spring. Okay, that's of course the big unknown. We know it's very dry in the western corn belt and in the plain states, not so dry that it would prevent planting. 2012 tells us it's very likely to get planted, but if that stayed dry into the summer, of course, that'll affect the harvested acreage and the yield more. Current forecasts that we have show pretty good moisture levels for the eastern corn belt and the mid-south, and of course the drought monitor shows the only real problems at the moment for the corn and soy area are in the Dakotas and leaning a little dry around the Great Lakes region.
Okay, here's one. Says your Ag Market Pro clients are still holding old crop corn and soybeans in the bins. What's your plan for recommending to sell those?
Well, yeah, we're sitting on between 20 and 30% of our old crop yet. We've resisted these prices simply because those trends on the charts that I showed you were still rising. As long as we're in the rising regression channel, there's a chance you'll get more for the grain. And as I mentioned with the basis, we think there's some potential for some really tight grain supply situations in some local areas this summer that would result in big basis pushes. So we're wanting to keep at least 10% of that of last year's production all the way into July and August, just on the potential for being the only guy in town or in the county that's still got grain to sell and somebody wants it. We are using a scale-up approach, so if we get any follow through to yesterday's rally, today's rally, over the next 30 days, we probably will sell some more of that old crop corn and soybeans into that rally. But the plan right now is to hang on to a little bit of the cash physical beans for summer because of that potential tightness, particularly on the bean side.
Okay, excellent. Last question here, I believe, so far anyway, there may be more coming in. How do you weigh the risk of China canceling or deferring purchases, and what will that do to the balance sheet and prices?
That's a really good question, a very challenging question. What we think is going on is China needs the corn specifically. That may be diminishing, that need may be shrinking a little bit because they've had another ASF outbreak. They're losing more hogs. I think the fact that they bought 29,000 tons of pork from the U.S. last week kind of reinforces the idea that their hog herd has taken another hit here. But they have bought a tremendous amount of corn, whether that's for the hogs or as part just because of the phase one trade commitments. So we think that there is quite a pretty good need for the corn, which will tend to keep them from wanting to cancel it. On the soybean side, they've bought some beans that they haven't shipped. The totals are lower than in recent years, but they've also got record production coming out of Brazil, and a decent crop in Argentina that they can draw from as well. So we're probably more vulnerable to a soybean cancellation or deferral, where they just don't get shipped till next marketing year. On the bean side, it does boil down to politics to a degree. We know that over the last 4 years, the whole U.S. structure is now kind of aligned behind the fact that China is a competitive threat, that their autocratic and single party system is they're trying to promote that worldwide. The big flashpoint will be Taiwan. Okay, there's concern. China has historically said Taiwan is a Chinese province, even though everyone who lives in Taiwan fled the communists to get there. Just about everyone. They don't want to be communists, and they saw what's been happening in Hong Kong. But the biggest potential for cancellation is probably that somebody miscalculates on the Taiwan relationship. Either the Chinese make aggressive moves forward there, and sanctions are the result. That's probably besides China canceling, the biggest risk would be other countries, including the U.S., cancel on them. In other words, embargo China because of something going on geopolitically. It would really torpedo the balance sheets, though, if we take 500 million bushels or more out of the export program because China's not there.
Okay, so a high risk in terms of impact, but low risk in terms of probability.
Yeah, they've got a big hammer. We hope they don't drop it.
Yep, exactly. Okay, very good. One more question did come in from the audience. Are you able to impart any insights on the sugar beet market, Alan?
We do look at that within, and obviously the relationship between sugar beets and wheat in the crop rotations, spring wheat. But I really would prefer to take that question offline, where I can pull up some of my data and discuss it more directly. I'd encourage that individual to contact us directly.
Sounds good. And he can either contact you directly, or I can connect you with them as well. Excellent. All right, Alan, are you still accepting new clients?
We are still accepting new clients. We don't do a lot of advertising, a lot of promotional. Many of our clients are coming in by referral from our existing clients. We've had Brugler Marketing and Management since 2002. I've been in the business much longer than that, but I've got good quality analysts here ready to take over for me. So yes, we are still accepting clients, but again, you probably aren't going to get a mailer from us. You need to call our number and ask.
Okay, perfect. I do have one more. I thought this gentleman had left the webinar, but he is back on. And he was asking about wheat and why there is more wheat seeded, since it's not really an economic, the economic value is not there compared to corn, wheat, and beans.
Well, that's a great question. Yeah, there were some people that were speculating the spring wheat acreage might only be 10 million or 10.5 million, and that was not the case. It was 11.7. There was more winter wheat discovered than was reported in January. I think that's the right way to word the winter wheat situation. USDA does occasionally find more winter wheat in this March survey than what they picked up in the December survey. But yeah, economically, wheat's a poor choice, but so is cotton. Okay, both of them. We have a spreadsheet where we just dial in all of those different crops and say we take the land cost out and just say, if you could grow any of these on here, what would you grow? We do factor in the cost of production at various yield levels. Wheat is third choice after corn and soybeans, but there's good reasons for having wheat in the rotation. Okay, you can spread out your labor. You're normally harvesting that, particularly winter wheat, at a different time of year than corn and beans. You can spread out your machinery for the same reason. The combine isn't doing anything else in June. It might as well be combining wheat. You can spread your price risk a little bit. by having a different crop and a crop that's on a different harvest cycle. And don't forget, in many cases, winter wheat is your base for your double crop with your soybeans, and the economics look really pretty attractive right now for winter wheat, followed by double crop soybeans. If you lock in these $12 type futures on the beans, you don't get quite the yield on double crop beans, but the combined revenues from the wheat and the soybeans make it pretty attractive in the areas where you've got enough growing season to do that.
Sounds good. Okay, well, thanks so much, Alan. Thanks for being a part of our webinar here this afternoon. And to the audience, thank you all for joining us. It's, I think, been a very informative and enlightening review of the market, so appreciate it. If you want to reach out to me to learn more about Commodity View or the other agribusiness tools that Barchart offers, I'm Michael Browne, mbrown@barchart.com. My phone number is on the screen. And if you would like to reach out to Alan, I'll just bring his up here one more time as well. And there's Alan's contact information as well, Alan B at bruglermktg.com. And his telephone numbers are on the screen there. So again, thank you all very much. This concludes our presentation for today. Have a wonderful weekend, and we'll hopefully talk soon.